So I told you a few minutes ago, or an hour and a half ago, that free cash flow is the preeminent cash flow. It is the cash flow available to investors in the firm. Well, if it's available to investors in the firm, then it must start with this EBIT or operating income. And then it's going to, since it's cash flow, we're going to add depreciation back. We have to make some adjustments for taxes because taxes can never be ignored. But sometimes the firm also has made future plans and commitments, and they planned capital acquisition. There's some additional piece of equipment that they're buying or building. And maybe as the firm grows or shrinks in size, it has some commitments to different levels of net working capital. So free cash flow, the equations for free cash flow take all of those into account. You're going to find that there are 3 separate equations for free cash flow. 2 of them technically look separate, but they're the same thing. You just don't immediately see it. And that's these 2 here. Free cash equals no plat plus depreciation minus change. This little delta means change in net working capital minus net capital spending. And that's one equation. And by the way, that's the equation we will use 95% of the time for free cash flow. It happens, just so happens to be that you get the exact same outcome when you take no plat minus net investment. And I'll explain net investment in a moment, just as I'll explain these other change in net working capital and net capital spending. Okay? These 2 equations, if you do them correctly, should give you the exact same outcome. However, there's a 3rd equation. And that we refer to this as the KVD, or key value driver equation for free cash flow. And that is no plat times 1 minus G, or long run growth rate, divided by ROIC, or return on invested capital. You're going to find that not only does this equation most often yield a different outcome, but you'll find there's a reason for it. And you'll only use this equational structure, A, when I ask you to, and B, when we're motivating the key value driver equation for free cash flow. Mandy, that is just way too cute. Good for you. And or C, when we are working with a valuation multiple. So, in fact, Mandy, I believe I've known Mandy since before there was baby, right?
What was that?
I've known you since before you had your child, didn't I?
Yep, you did.
Were you in our undergraduate program, or
Yeah.
That's what I thought. You were in Finance 309. I'm sorry. So some of this probably sounds familiar to you, doesn't it?
A little bit. Yeah, the WAG definitely does.
Yep. Yes, the WAG definitely does, yes. So we will use this equation, but we will use it sparingly, okay? Let me walk through some of the structures here. So here is the extension of the first equation. So no plat plus depreciation. So we're taking EBIT times 1 minus the tax rate. That gets us to no plat. Then we're adding depreciation back into this. So that's almost like a tax-adjusted EBITDA, right? Now we're going to take minus the change in net working capital and minus net capital spending. Well, net working capital is current assets minus current liabilities. You probably remember that. And change in net working capital would be the net working capital from one period minus the net working capital from the period before. You will oftentimes see me use these little subscript notations. And 1 and 0 simply means 1 is the most recent and 0 is something that came before it. Okay? I could just as easily said now and before, or A and B, or 2019 and 2018. They're just subscripts. They don't do anything other than help you keep track of where those numbers are coming from. They're not exponents. Net capital spending is effectively the amount of new money we spent on capital goods. And when I'm talking about capital now, I'm not talking about our capital structure, equity, preferred, and debt. I'm talking about the capital on the balance sheet. So I'm talking about, in this case, real estate, technology, equipment, patents held, and private equity, in this case. Okay, so those are the assets. These are our capital assets, our capital components for the operation, as opposed to the capital components for capitalizing the business. When I look at the next equation of free cash flow being no plat minus net investment, well, net investment is the change in invested capital. And invested capital happens to have two definitions, two equational structures, the finance structure and the operations structure. And when we're applying invested capital equations to the entirety of the firm, these two equations will yield the exact same numbers, assuming we're doing it correctly. However, I almost always use the operations approach, so the invested capital operations approach, which is the fixed assets plus net working capital. So fixed assets, whatever the fixed assets are of the company, here they're the total fixed assets, plus net working capital, and again, net working capital is current assets minus current liabilities. So fixed assets plus net working capital, okay? That's the operations approach. The finance approach would be taking total long-term debt plus total equity. That's not a minus sign, that's a hyphen right here, okay? So total long-term debt plus total equity. Well, long-term debt is 34.82. Total equity is 110.648. And those combined will equal the exact same number as the fixed assets plus net working capital. Let me show that to you. Here we got invested capital and from time one, and it gives us 145.468. I've done this using either approach. And in this case, you can see by the components that that I'm taking fixed assets plus net working capital, but it gives us the exact same number. But in this case, to get to net investment, it's the change in net working capital. So let me come back up. Net investment is the change in, excuse me, not net working capital, change in invested capital. So I have to calculate it for 2 periods of time. And I can then motivate the free cash flow equation. It's going to take you doing this a few times before you get this straight, which is why after each one of our discussions, you'll have a problem set, an Excel assignment. That's after the first few. And then after we get past week 3, you got a problem set, an Excel assignment, a practice homework, and a homework. And that sounds like a lot of work to go through, but the problem set and the Excel assignment and the practice and real homework, they tie into each other. So when you're doing these, the first thing I would do would be the Excel assignment. As you're going through your weekly work, do the Excel assignment first. You'll find that when you do that, you're creating the Excel model that will help you do the problem set. So if you've created that part of the model, you then put into that model the new inputs that I introduced to you in the problem set, and it will give you the answers to the problem set. It then is the same model you can use when you're doing the practice homework and the homework quizzes. You can use that model, put in yet new inputs, and it will give you the outcomes. So by the time you have to do something that is counting for grades, you will have done this, whether it's mathematically or through Excel, 4, 5, or 6 times. And that repetition is going to be your salvation. That's the only way to get this stuff to sink in. I know a few of you are starting to wonder. I can tell by the looks on your faces. Okay? We're almost done, by the way. We've only got a couple more slides to get through. You okay? Okay. Thank you. Kylie, you don't smile a lot, but just you nod your head, and I appreciate that. Okay. So now we're going to use Mayor Giovanna's numbers again. And we'll be talking about where these are coming from. I'm going to calculate free cash flow. So I start with EBIT. And I take 1 minus the tax rate. So 51.063 minus the tax rate on EBIT. By the way, what is the tax rate on EBIT? Carol, do you remember? This is 2019. Anybody can help.
Was it the 30?
793.
So for 2019, After this flat tax has gone into effect, the tax rate on
Isn't
heat
it
is 26%.
26%?
So 1 minus that is 0.74. So it's 51.063 times 0.74 is going to give us no plat. We will add to that depreciation of 3.89, and we're well along our way to our free cash flow equation. Here we have EBIT times 1 minus the tax rate. Here we have depreciation. Here we have minus change in net working capital. Well, change in net working capital, we had current assets minus current liabilities for the first year, minus current assets minus current liabilities for the year before. And that equaled 17.13, which is why I'm taking it as a subtraction right here. Then minus net capital spending. Well, what was net capital spending? Well, it is the fixed asset from time 1 minus the fixed asset from the time before, or time 0, because 0 comes before 1, plus depreciation. So we have fixed assets from time 1, fixed assets from time 0, plus depreciation, gives us net capital spending of 22.78. We take that as a deduction, and it tells us that our free cash flow is 1.768, or 1.7687, as it turns out. Lots of little numbers, right? Tiny little disparate pieces of information floating through our cosmos here that actually will start to congeal as you start using them more. And here I go through the same exercise, but I take you through how to find this number using the no plat minus net investment equation. I don't want to spend much time on this part at the moment because we're going to come back to this later on. I just want you to believe me, the no plat minus net investment comes up with the same outcome as no plat plus depreciation minus change in net working capital minus net capital spending. Next week, I'll give you a relationship between those. You say, oh, that makes sense. But at the moment, I don't want to give you that relationship. But we come up with the exact same amount, 1.769, or almost the exact same amount. We had 7,686, which would extend to 769, okay? So that's those first two equations. But now there was that third equation. And that third equation looked like no plat times 1 minus growth divided by ROIC. When do you use this equation? Lisa, do you remember when we used this particular equation, the one I called the KVD equation? David, do you remember by any chance? It's okay, I barely remember myself. You use it under one of three conditions. Either A, when I tell you to, or ask you to in a problem. B, when you're motivating what's called the key value driver formula, which we'll talk about in a couple of weeks. Or C, when we're trying to reverse engineer a valuation multiple. So we're not going to use this much. Have you run through it in a couple of our problem sets? Because I want you to begin to understand when, why, and how it sometimes comes up with a different number. Remember that the first two forms of free cash flow came up with about 1.77, let's say. 1.77, 1.77. And then when we apply that third formulation, free cash flow is 34.15, which is a very different number, especially when we're talking millions, than 1.77. So the real question is, why is it so different? If they are all three viable equations for the same output, free cash flow, how is it they can be so radically different? We're not going to spend any real time on that tonight. I'll show you mathematically in another time. You guys have absorbed enough of this arcane detail tonight, okay? But notice that not only do we have different inputs in G and ROIC, we have a different construction. The other two equations are additive, so it's just adding and subtracting. This equation is products and quotients, so multiplying and dividing. And that different structure, when we bring into it the second and third of what McKinsey and Company calls the key value drivers, KVD, key value drivers, which happen to be no plat, so that's one of the three key value drivers. Long run growth, or lowercase g, is another key value driver. And then ROIC, or return on invested capital, is the third key value driver. When we bring those into the equation, we are now forecasting into the future. We're wagging, and it comes up with a very different number. So we'll talk about the interpretation of that next week and a couple of times beyond that. In this case, I'm using 2.5% as the long-term G. And return on invested capital is no plat divided by invested capital. Well, you remember where those numbers were, 37.787 and 145.468. So we had an ROIC of 0.2598, or just shy of 26%. So growth of 2.5% divided by return on invested capital, 26%. We take that, subtract it from 1, and multiply that by no plat, and it gives us this much different number. Well, the issue must be in the dynamics of G and ROIC. And I'll help you see that more clearly next week. Any questions that you can articulate at the moment?